Thank you, Em. Bill Bachhoffner, and on behalf of the Camden Conference, I'd like to welcome you to tonight's program. And we'd like to thank Rockland Public Library and the Friends of the Rockland Public Library for making these programs possible. For those of you who don't know, the Camden Conference is a nonprofit, nonpartisan citizens forum driven almost exclusively by volunteers from our community. The mission of the Camden Conference is to foster informed discourse on world issues. In keeping with our mission, we offer a series of community events leading up to our annual weekend conference. These free events are intended to provide background on the yearly topic and to touch on areas related to the February conference that may not be covered in its three-day format. This year's conference, our 36th, Global Trade and Politics, Managing Turbulence, will take place February 17th through 19th, 2023, live at the Camden Opera House. Early ticket sales for the members of the Camden Conference began October 24th. We encourage you to become a member of the Camden Conference if you are not already. CamdenConference.org is the website to address. I want to alert you to some future community events that will be of interest. On November 20th, we have Managing Turbulence, a poetry sampler on Zoom that will be hosted by the Cushing Public Library. And then on December 1st, we'll be back here at the Rockland Public Library with Bill Hall's Beyond Supply Chains, America's Changing Economic and Trade Policy. Tonight, as part of our community event series, it is my pleasure to introduce Amanda Rector, who shares her insights into the trends and outlooks for Maine's workforce and economy. Amanda is the State Economist for the state of Maine. In this capacity, she conducts ongoing analysis of Maine's economic and demographic conditions to help inform policy decisions. She started working for the state in 2004 and has been state economist since 2011. She earned a BA in economics from Wellesley College and a master's in public policy and management from the Muskie School of Public Service at the University of Southern Maine. Amanda holds membership on the State of Maine's Revenue Forecasting Committee, the advisory board for the New England Public Policy Center at the Federal Reserve Bank of Boston, and the Board of Visitors at the Muskie School of Public Service. Amanda also serves as the governor's liaison to the U.S. Census Bureau. Amanda is originally from the Mid-Coast, Maine, and now lives in union with her family. Please help me give a warm welcome to Amanda Rector.
Hello, good evening, everyone. This is, I'm delighted to be here. I volunteered at the Camden Conference many years ago. And of course, I grew up actually in Camden, and I have family here tonight. So it's a very friendly audience. I think I'm related to like a fifth of the people here. So I'm going to talk about the trends and outlooks for Maine's workforce and economy. And I'm going to talk through demographics, first and foremost, labor force and employment, wages and income, state GDP, inflation and spending. And then I'm going to take a little bit of a look ahead at what might be coming down the pike. And hopefully there will be time for questions, discussion, etc. At the end. So let me start out with demographics. If you've heard me speak before, I always start with demographics, regardless of what I'm asked to speak about. I talk about demographics first because it's really important to understand who the people are that make up the economy. The economy is just made up of people making decisions. And if you understand who the people are, then you have a better chance of understanding what's happening in the economy. So I'm going to start out with sort of the big picture. This is components of population change for Maine. So taking a step back from that, the decennial population, 2020, 1,362,359. Maine is the 42nd largest state in the US. Our population growth over the decade actually was also 42nd, about 2.6% population gain. If we look more recently, just the most recent year, 2020 to 2021, pandemic era, Maine's population increased 0.7%. That was 14th in the US. all of that driven by migration. In fact, if you look at migration, Maine was 7th in the US for our net migration rate. So if you look at the components, the red is deaths, the green is births. We have more deaths than births each year. Natural population decline. If population change was only made up of births and deaths, Maine's population would be declining. It's not, though. People move. And so we have a little bit of international migration. It's a very small little sliver in there. It is positive, but it is not very much. Domestic migration, people moving to and from Maine from other parts of the US, makes up the bulk of our migration and is more than enough to offset that natural decline. So we actually gained about 10,000 people just in that 1 year from 2020 to 2021. If we divide the state into a few regions, so the blue counties on the map here are the coastal region, mostly the coastal counties, except for Washington County, which we group in with what we call the rim counties. And essentially, if you follow the Canadian border and then pick up Piscataquis County, that gives you the rim counties. And then what's left in the middle, we call the central region. So if you look at those counties and those regions, all 6 of the counties that are in the rim region, plus Penobscot County, had their highest decennial population count in a year other than 2020. So their population peaked before the most recent decennial census. Now, some of them, it was 2010, and we saw enough migration in 2021 that they have the chance to maybe 2030 decennial population will be higher, and they may reach a new peak if we see those migration trends continue. But Aroostook County, 1960, Piscataquis County, 1920, Washington County peaked all the way back in 1900. If we look at the components of change, again, for the most recent year, 2021, by county, you'll notice Piscataquis County actually picked up some pretty good gains. They had the highest rate. Now, it's a small enough population that it doesn't take too many numeric changes to make a big percentage increase or rate increase. But Piscataquis County saw a lot of migration in 2021. There were 2 counties down at the other end. Aroostook County actually saw a little tiny bit of decline. It wasn't that they saw out migration, it's that the deaths and births situation was so negative that what they picked up for migration was not enough to offset that. And then Androscoggin County actually was pretty much static in terms of the population change there. And that was because they had a much smaller net migration in Androscoggin County. So let's talk a little bit about housing. So what happens when you have a lot of people moving around? They need a place to live, right? So this is the active listing housing inventory for Maine. Now, the first thing you'll notice is that it's very bumpy. We have these very high peaks in the summer. Everybody lists their house for sale in the summer, and nobody wants to move in the winter. So it's much lower in the winter. But you'll also notice there's been this downward trend for several years pre-pandemic. That gray vertical bar in there is the recession period, which essentially you can sort of mark that as early pandemic. But if you look back at the beginning of this is a pretty short time frame. The beginning of this is about July of 2016, and there were about 14,000 active listings then. If you look at where we are more recently, we didn't see that seasonal bump during the pandemic. Of course, people weren't sure what was going on. They didn't want to have to try to move at that point in time. We've returned to that seasonal pattern, but we're only about 4,000 now at the peak. So many fewer houses available. Part of that was an increased demand. Part of that is this limited supply that we've had as there have been fewer houses built over time leading up to this point. So what happens if we have a lot of people who are moving in and want houses and not a lot of houses for them to buy? Prices go up, of course. And so we've seen house prices increase very dramatically, not just in Maine, but in New England and the US as well, but Maine even faster. Now it has started to ease a little bit since then. I think the most recent data point just recently came out, and I think we're a little bit lower too. But remember, we're still higher than we were previously. Those are still very, very high house prices, even if the rate of growth is slowing. So what has that done for home ownership affordability? So this is 2020. So really before that big in-migration and house price increase that we saw. The counties in red were all considered unaffordable. So the median home price was unaffordable for at least half of the households in the area. I've color coded it because it's a little counterintuitive in terms of the higher you are, the more unaffordable you are. The green counties were the ones that were still considered affordable. And if you look at those, they tend to be the more rural. A lot of those rim counties show up there: Aroostook County, Piscataquis, Somerset, Penobscot, Kennebec, Washington County. So what happened for 2021? Everybody got more unaffordable. And there are only 2 counties that were still considered affordable. And one of those, Washington County, was really close to that 50% mark that would tip them over into unaffordable. Now, this is home ownership. Rental is actually even worse because in many of the more rural places, there simply isn't any available rental housing. And so it's even worse on the rental side of things than it is on the home ownership side. So I'm going to shift gears, going back to demographics again. If we look at the change in population by race and ethnicity. So we've seen this shift. If you look at the chart, we saw a decline between 2010 to 2020 in white alone and a big increase in 2 or more races. So 2 things going on. One is that migration of people in was of more diverse populations than the existing population in the state. But also the Census Bureau changed the way that they were essentially reading the results of the decennial census. They were picking up more characters in one of the fields, which meant that people who had previously been categorized as white alone were now being categorized as 2 or more races. So essentially we were picking up existing diversity in the population that we didn't know we had because of how the Census Bureau was reading the census results. So we did improve. We went from 5.6% Black, Indigenous, and people of color in 2010 to 9.8% in 2020. That's a big increase. We're still the lowest in the US. So we still have a long ways to go before our diversity is anything like that of the rest of the country. If we look at sort of what that looks like, if you break down the percentages, Maine is all the way over on the left there, and you can see that lightish blue section down at the bottom, that's white alone. So it's still very much the predominant race and ethnicity in the state. You can see a little bit of the diversity up at the top there. And then I've picked out just a few counties. These are some of our more diverse counties. Androscoggin and Cumberland sort of come to mind as Maine's more diverse counties. You think of, you have the Portland area, you have Lewiston, Auburn. But Washington County is another one, and that's because there's a larger Native population in Washington County. And so you'll see that the mix of colors there is a little bit different because the mix of races and ethnicities is a little bit different there as well. So let's talk about age now. Maine is the oldest state in the US. Everybody knows this. We've been talking about this for a while now. That is not news. We have the oldest population by median age, and we have the oldest population by the percent of the population that's age 65 and over. If you look across the counties, there are a few that are below the statewide median: Androscoggin, Cumberland, Penobscot, Kennebec just squeaks in under the line, and then York is sort of just over the line. So what do those counties have in common? Well, they have our more urban areas, and we don't have really urban areas in Maine, but they're slightly more urban. And they have colleges and universities. So those 2 things bring in more younger people to help bring down the median age. But this is really important. Maine was the only state in the whole country to see a decrease in the median age from 2020 to 2021. That was very exciting for me to see when I saw this number. Now, admittedly, it went from 44.8 to 44.7, so it wasn't a really big decline, But we were the only state to see that decrease. And that's because of all of that migration. And a lot of that migration, we saw more people under the age of 45 moving into Maine than over the age of 45, which managed to bring that median age down a little bit. So here is a population pyramid for the state of Maine from 1950. So what are you looking at here? Each one of those bars represents the percent of the population in a different age sex cohort. So 1950, the baby boomers were just starting to be born. They were all under the age of 5 at that point in time. So the base of this pyramid, under 5, is very, very wide. Baby boomers were born between 1946 and 1964. Now, related to those median age and oldest population, Maine also has the largest share of baby boomers of any state in the US. So if we look at the top of this, it's very narrow because not a lot of people were living over the age of 85. And so it looks roughly like a pyramid, hence the name. So if we click through a few decades here, you'll notice that there's this bulge of baby boomers moving up through this pyramid. So if we stop in 2021 for a moment, baby boomers in 2021 between the ages of 57 and 75. So they're moving into traditional retirement years pretty solidly at this point. Now, we've also seen the top of this pyramid expand because life expectancies have increased over time, of course. And we don't have the younger generations following to the same extent that other parts of the country do. And so this really is creating this very top-heavy effect. If we look ahead at some projections, and these are old projections, I'm trying to update them, but I'm having to jump off of 2020. And as you might imagine, the data is really, really challenging. So they will eventually be updated. But at this point, the general trend will stay the same. The baby boomers are continuing to age into those uppermost age cohorts. So they'll be between the ages of 64 and 82 in 2028. And without additional migration of younger cohorts, we've essentially started to turn this pyramid upside down. So of course, with that older population, I talked about this earlier, we have more deaths than births each year. And you can see where that crossover happened about 10 years ago. And that blue line of births as it trailed off down at the left-hand side of the chart there, that was as the baby boomers were aging out of their childbearing years. And we've seen the number of deaths increase very dramatically during the pandemic period. We did see births tick up in 2021. Part of that may be the catch up from 2020 when people were perhaps a little bit less likely to have a child because they weren't sure what was going on. So some of that may just be noise shifting between those 2 years. So why do I spend all of that time talking about demographics? Well, one of the reasons is because our population really sets our labor force. So let's talk about labor force. First, a little bit of a transition from demographics to labor force. This is the percent of the population aged 25 to 64 years. Those are really the prime working age years. Certainly there are people on either end of that who are working as well, but these ages have the highest labor force participation rates. And you'll notice, so the US, I've put in there in sort of the lighter color, so that you can see there are actually some of our counties that have a higher percent of the population in those prime working age years, and some that are lower. However, I will remind you that the tail end of the baby boomers are still within these ages as well. So as the baby boomers move out, some of these counties may move to the other side of this, the balance with the US here. So here's Maine's civilian labor force, total civilian labor force. This chart goes all the way back to 1947. I have no idea how accurate the data from 1947 is. I would suspect probably not very, but it was there, so I thought I would grab it. The first thing you'll notice here is this really rapid period of growth that happens from about the late 1960s through to about 1990-ish. So what was happening? We had the baby boomers aging into their prime working years. We saw some pretty good migration into Maine, primarily of baby boomers, and we had women joining the labor force in much larger numbers than they had previously. So that was sort of a perfect storm of really rapid labor force growth. And then it eased, and then we've started to sort of trend down a little bit more recently as the baby boomers are now aging out of their prime working years and into some of the traditional retirement ages. If we look more recently at what's been happening, this is just sort of a 30-year snapshot. You can see we've been trending down, and the US has as well. That's the orange line. It doesn't bounce around quite as much as the Maine rate does. You can see when the pandemic hit, both labor force participation rate for Maine and for the US dropped very, very sharply. There was an initial rebound, and then the US has continued to make some gains, still below where we were pre-pandemic. Maine actually turned back down the other direction. Now, the Department of Labor most recently has been looking at these numbers. It comes from a household survey. It is a very, very small sample size in Maine. And their guess is that probably this is underestimating the available labor supply. It's likely to be revised up when they do the benchmarking. Because if we look at employment, which I'll get to in a few minutes, it's a different story. And the employment data is much more reliable than this household survey data. But the other thing that I'll point out here, and this is from a recent report that the Department of Labor put out, the persistently lower rates through the summer of 2022 are mostly caused by aging and retirement decisions that may have been accelerated during the pandemic, and not by lower participation among people between the ages of 20 to 54. So the bulk of those prime working age years, they're back. They're back in the labor force at their pre-pandemic levels by and large. That gap is people who likely have retired. Now we may get some of them back. Unretirement is a thing. People do that, particularly when things like the stock market and financial situations change and start to go down a little bit, and people have to come back into the workforce. But people also make the decision for other reasons. They get bored, they're tired of their kids-in-law saying, hey, can you come work on my house? Things like that. So there are lots of reasons people might come back into the labor force. But certainly what we have seen is an acceleration of a trend that we knew was coming anyway, as the baby boomers were moving into these retirement age years. So we are likely to perhaps not regain back to where we were pre-pandemic because of those accelerated retirements. If we look at the unemployment rate in September, it's just a little bit above pre-pandemic levels. If you look at the long run, I put 30 years in here to give you some perspective because it's hard to tell if you're looking at just sort of the pandemic era. But that is really, really low. So before the pandemic, we had exceptionally low unemployment rates, and we're really right back there now. So we have very low unemployment, and we have a smaller labor force. That makes the available labor pool very limited. So the labor market is very, very tight right now. If we look at employment now, you can see our pre-pandemic peak, 2019, we had about 637,000 was total employment for the state. This is non-farm employment. We, of course, saw a very sharp decline during the pandemic. We gained more than half of that back in 2021. And year-to-date information that was just recently shared with the state's Consensus Economic Forecasting Commission. That's the official group that sets the economic forecast for the state. They just released their new forecast November 1st. So good timing for this because I have new numbers to share. This is their forecast here. We're really just about back this year with the pre-pandemic level. A little bit shy. The expectation is that next year we'll see a little bit of growth, and then they have this plateau. And that plateau is a direct reflection of those demographics I spent all that time talking about earlier, because we simply don't have the people moving into the workforce to offset the people who are moving out of the workforce. And you need to have more people available to be able to really increase your employment levels. So that employment level is really a plateau. Now they've had this plateau in their forecast for quite a few years now, and we keep managing to sort of exceed it. So they keep bumping that level up and up. The expectation is that we will continue to see migration into the state if that migration is stronger than expected. And if we manage to see labor force participation rates return to higher than expected levels, we might see this employment level bump up a little bit further. But really, it's a matter of playing against those demographic forces. If we look at employment by industry, so this is the share of total employment by industry. Trade, transportation, and utilities is the largest in Maine. Most of that is retail trade. That is really a reflection of that strong tourism economy that we have in a lot of the state. Next to that is healthcare and social assistance. After that is government, and that includes federal, state, and local, and it includes all of the public education. So K through 12, community college, public university, all of that is lumped into government, which is why that is so large. Next to that is what is really most interesting about this chart. So leisure and hospitality and professional and business services back in 2019 were about the same share of the state's employment. They were pretty much neck and neck, tied for fourth. What happened during the pandemic, of course, is that employment in leisure and hospitality dropped quite a bit and has had trouble coming back. This is annual data, so 2022, it's seen better gains, and hopefully we'll be back to its pre-pandemic levels. But at the same time, we've seen employment in professional services, professional and business services continue to increase. And so that has been an increasingly important part of the state's economy. And so now is really pretty solidly in fourth, ahead of leisure and hospitality employment. I wouldn't expect to see those reverse again in 2022. I think we're going to continue to see professional and business services growing and continuing to sort of hold that next slot in the rankings. If we look at the monthly data, this is total non-farm employment not seasonally adjusted, which we don't often look at, but I've found it really helpful to look at during the pandemic because we could see this. So we have a very seasonal pattern here with our employment. Highest during the summer, it's lowest during the first quarter of the calendar year, essentially the winter months. And then you could see where we fell off a cliff in April of 2020 with the pandemic. And then you can sort of track how we're recovering. So if you look at the gray line, that's 2019, so pre-pandemic, normal employment levels. The green line there is 2022. And so we've been tracking pretty well on top of the 2019 pre-pandemic employment, hence the forecast to get back pretty much this year. Now, this non-seasonally adjusted data does tend to get revised, so we'll see what happens in the rest of the year. But the expectation really is that we're pretty much back. If we look at those employment sectors, most of them were back, with two big exceptions. One, healthcare and social assistance, most of that in long-term care, nursing homes, and social assistance, which includes childcare, most importantly. And then state government education, and that really is the public higher education sector. So I want to look at just a couple of these sectors in more detail just to show you. So leisure and hospitality, as I said, was below their pre-pandemic levels for a while. There was that persistent gap through 2021. They just could not close that gap. But if you look at where we are for 2022, there's that gap at the beginning of the year. And then as we hit that really high summer peak, they were able to close that employment gap and really have managed to stay back to where they were pre-pandemic. Healthcare and social assistance, really troubling. So had closed that gap, and then the gap opened back up again. And you can see, if you look at the blue line, 2021, you can see where starting in the fall of 2021, that sector lost employment again. And there was a lot of burnout. If you talk about nursing, if you talk about childcare, there was a lot of employment loss in that sector. And if you look again, green line versus gray line, that gap has just persisted right straight through this year. So that's one of the big remaining pandemic era gaps. Construction, on the other hand, barely saw a blip during the pandemic, came right back up. And if you look at the green line there, has been well above their, not just the pre-pandemic, but last year we grew on top of that. There has been construction everywhere of all kinds. Housing construction, road construction, business construction. If they could hire more people, I'm sure they would, and this employment would be even higher. But again, they have a hard time finding available workforce. State and local government education. So remember I said state government education is one of the other, that's the other one that's still lagging. This is state and local combined. But it has this interesting sort of reverse seasonality, and it's because during the summer, of course, kids aren't in school or at college and university, and so the employment levels decline over the summer. And you can see that they still have that gap there. It's a little bit harder to see because the August to September is so sharp. If you look at the spring semester of 2022, essentially, you can watch that gap. It will be interesting to see what happens with the rest of this fall semester, whether we see that close a little bit more or if it opens back up again. So let me talk about wages and income now. Of course, I've been talking about a really tight labor market. And again, hey, supply and demand, Econ 101. There's a lot of demand for workers and there's a limited supply. So the price has been going up. In this case, the price is the wage. So we've seen wages increase. Now this is average wage per job. And if you look at the blue line, that first really sharp increase in there, part of what was going on is we had higher total wages and we had lower employment because during the first part of the pandemic, employment was so much lower. So that caused this really sharp increase, but it's continued to increase since then. And that really has been because we've seen wages increase as there's been a lot of demand for workers and a limited supply. But now if you look at the orange line, we saw that sharp increase and then it turned around and has come back down a little bit. And that's because inflation has been so high that it's been eroding those gains. Those really sharp gains aren't quite as sharp when you factor in inflation. If we look at total personal income for the state, this isn't per capita or individual, this is the whole state total personal income. If you look down at the bottom, 2019 is sort of the usual year. These are the major components of total personal income. About 43% comes from wages and salaries. 21% comes from personal current transfer receipts. What in the world are those? Well, it's money that gets transferred from a government to or on behalf of an individual. And I have another chart on that in just a second because that's going to be really important. 19% dividends, interest, and rent, 10% is the benefits package that goes with the wage and salary, and 7% non-farm proprietors income. So what happened in 2020 Q2 and 2021 Q1? Those are the second and third lines down here. We saw wages and salaries at 37% and 38%, transfer receipts all the way up at 31%. And now we're back at 2022 Q2, looking much more like sort of the 2019 usual mix of things. Transfer receipts, those really increased. What was going on there? Well, so again, 2019, usual mix. These are the components of personal current transfer receipts. 36% Social Security, 25% Medicare, 19% Medicaid. That normally makes up the bulk of this line. Now, as you might imagine, with an aging population, you have more people who are collecting Social Security and Medicare. And so this is an increasingly larger part of Maine's total personal income, regardless of what else might be going on. Then you've got a little 1% sliver in there that's unemployment insurance, then 14% everything else. And that includes veterans benefits, it includes education benefits, income maintenance benefits, and anything else that just gets lumped in there. So what happened in 2020 quarter 2 and 2021 quarter 1? 22% Social Security, 15 or 16% Medicare, 12% Medicaid. There were not fewer people collecting Social Security. If you look at the dollar amounts, they did not shrink. What happened was that those other components really increased. So 14% unemployment insurance in the second quarter of 2020. So there were more people collecting unemployment insurance and there were enhanced unemployment benefits in place. 37% all other, and that included stimulus checks that went out. It included some parts of PPP were in there and other federal stimulus programs. And then the first quarter of 2021, unemployment was down a little bit. Some of that, the unemployment rate had come down a little bit at that point, and some of the enhanced stuff had expired. 45% all other. There were 2 rounds of stimulus payments that went out. And so that was really the biggest piece of the transfer receipts and what caused this very noticeable shift in the components here and for total personal income. And if you look at 2022 second quarter, the top line there, we're pretty much back to the usual mix again. All of those federal programs have expired or are phasing out, and unemployment really is right back to where it was previously. So it's basically non-existent in here. And so we're really back to the normal mix of transfer receipts and total personal income. So I want to talk a little bit more about all of those federal supports. If you look at the National Supplemental Poverty Measure, and this is different from the official poverty measure because this one takes into account things like taxes, government programs, other supports that are in place. In 2021, the National Supplemental Poverty Measure was 7.8%. That was lower than 2020, and it was the lowest rate since the measure was first published. If we looked specifically at the child poverty rate, that fell 46% in 2021, again, to the lowest rate on record. And part of what was going on there specifically was in the second half of calendar year 2021, there were child tax credit checks that were going out to families. Social Security remains the largest anti-poverty program. It moved 26.3 million people out of poverty nationally. And in Maine, if we look at, we have a 3-year average supplemental poverty measure, again, because these are small numbers and they need to aggregate a few years together to get something that's reliable. It was 5.4%, that was 3.8 percentage points below the official poverty rate. And we were tied with Wisconsin for the second lowest in the nation. Minnesota was the lowest, I believe. So what does the forecast look like for total personal income and wage and salary disbursements? And again, this is brand new forecast. So if you look at 2020 data, you can see that really big increase in total personal income. And that was those transfer receipts that were really increasing it. On top of that growth in wages and salaries grew as well. 2021, wages and salaries grew even more. Total personal income grew on top of that prior growth. 2022, wages and salaries still growing, but at a lower rate. And total personal income actually forecast to be negative. Now, if you look at the actual forecast from the CEFC, and I think I've got that much later in this presentation, so you can look at those numbers in a little while. It's not a negative number. What I've done is I've adjusted this for their inflation forecast. So we have all of those federal programs unwinding. This is the reversal of all that growth we had with the transfer receipts. And then on top of that, we have really high inflation. Now, wages and salaries have been really strong this year. If you look at withholding data and you look at the wage data from the Department of Labor, it seems like this has been a very strong year of wage growth. And so that keeps it positive even after taking inflation into account. And then in the out years of the forecast here, we return to slightly more normal rates, a little bit lower, and that's because the inflation forecast is very high. If we look at median household income now, so we are talking households, we're not talking total for the state. Maine is in the yellow, and you can see we run behind the US by a little bit. We run behind New England by a lot in terms of the median household income. But if you look at Maine's counties, Cumberland County is basically right there with the New England average household income. York and Saginaw counties are a little bit behind. Those three counties together make up the Portland, South Portland Metropolitan Statistical Area. That'll be important in a second. Remember that. Down at the bottom end here, you'll notice Piscataquis County has the lowest median household income. And if you look at the names of the counties that are in there, again, those are a lot of those rim counties, those counties that also don't have the population growth. They tend to have some of the higher median ages as well. So let's talk about GDP. Remember I just mentioned the Portland, South Portland Metropolitan Statistical Area? Well, that makes up almost half of the state's GDP, just those three counties. It's 49.9%, so just shy of half of the state's economic activity coming from those three counties. The Bangor MSA, which is Penobscot County, is about 10%. The Lewiston Auburn MSA, which is Androscoggin County, it's about 7%. The whole rest of the state, all of the other counties besides those 5 that I just named, about a third of the state's GDP. So you can see where the economic drivers really are those metropolitan areas, and in particular, that Portland, South Portland metropolitan area. If we look at GDP by industry, that section in the middle stands out as being the highest, far and away. That is finance, insurance, and real estate. And most of that is real estate. Now, it's a little bit apples and oranges because they include an imputed rent measure, which basically means those of us who own our homes are renting them from ourselves, and they include that as part of that measure. But as prices have increased, this really has ticked up pretty significantly. You'll notice the past couple of years saw some very, very sharp increases as those home prices and rental prices have been increasing. Just to the right of that is professional and business services. Remember, I talked about how this has been an increasingly important part of the state's economy, and you can see how that growth has just continued up and up and up, and really steep increase in the most recent year there. If you look at the third in from the left, that's manufacturing. Manufacturing actually has done pretty well recently. During the pandemic era, it ticked up again, but had been seeing growth even leading up to that. Had a period of decline before that, but we're really back up to where we had been a number of years ago. The third in from the right is arts, entertainment, recreation. That's basically leisure and hospitality. And you can see the really sharp decline in the pandemic. It's made pretty good progress back, still not back all the way, but certainly has been increasing in the past couple of years after the pandemic. If we look at quarterly total GDP for the state and for the US, and they're on opposing axes so that they look reasonable and you don't have Maine's teeny tiny little share completely invisible compared to the US GDP, you'll notice that very sharp decline during the pandemic, and we popped right back up again. We had the shortest recession on record. That was also the deepest recession on record during the pandemic. It was only 2 months long, but it was also the deepest one on record. That's that very sharp V in the GDP there. More recently, you'll notice that we had been increasing and now we've tipped back down again. And if you pay attention to those sorts of things, you've suddenly heard the word recession being mentioned all over the place. So there's a general rule of thumb that says 2 consecutive quarters of GDP decline is a recession, right? Actually, in the US, GDP is not necessarily the only way that we look at a recession. We have the National Bureau of Economic Research that officially determines whether we're in a recession. Their description of a recession, they say a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. That is very vague. And it's very vague on purpose because it gives them a lot of leeway to be able to decide what they think is a recession and what those start and end dates of the recession are. It usually takes them a very long time to decide whether we've been in a recession or not. So we did see national GDP decline 1.6% in the first quarter, 0.6% in the second quarter. There were a lot of other indicators that were not really pointing towards recession. Employment was holding up, consumer spending was holding up. I would be very surprised if NBER came out later and said, oh yeah, that was a recession. It did not feel like a recession. If it was a recession, it was the strangest recession that I have ever seen. The third quarter GDP is positive again. So we've turned around. Now, that does not necessarily mean we're totally out of the woods. There is still a huge amount of uncertainty out there in the economy. There are a lot of economists and other folks who are thinking that 2023, we're probably going to see GDP decline again. We're possibly going to tip into a recession. When the CEFC met, they look at two different national level forecasts, one from IHS Markit, which is part of S&P, one from Moody's Analytics. IHS is forecasting a recession in their baseline for 2023. Moody's is not. So that gives you some sense of a lot of the uncertainty that's out there. There is no consensus yet about what 2023 is going to look like, other than the fact that it's really very uncertain. So let me talk about inflation and spending. The taxable retail sales have held up very, very strongly. Now, part of that more recently has been because price increases from inflation have contributed to some of this growth. But even before that, we've seen consumer spending holding up very, very strongly, as particularly during the first part of the pandemic, people couldn't go anywhere. And so they couldn't spend on the things that they often spend on, which are services. So instead, people bought stuff. And our economy, our sales tax system is built on people buying stuff. We tax goods, we tend not to tax services. And so that is really, we saw the opposite of what normally happens in a recession. Normally in a recession, you see the purchases of goods subside and the purchases of services hold up, which means taxable retail sales plummet. Just the opposite happened during this recession, which made it very strange indeed, but people couldn't go out and do stuff, so they bought things instead, and we taxed those things. And so we saw taxable retail sales hold up very, very strongly, and they've continued. So this is August 2021 to 2022, 20% increase in building supply. And building supply has seen substantial increases right straight through. It goes along, remember, construction employment was up too. Everybody's been doing things to their homes, things to their businesses. Building supply, very, very strong. Overall, 9.2% increase. Now, the forecast going forward expects that we will start to see more people shift back from buying goods to buying services. People sort of normalize their purchasing behavior. And so taxable retail sales growth is expected to subside in the forecast going forward. Inflation, let's talk about inflation. So this is the year-over-year percent change in the consumer price index. This is one of the most common measures of inflation. The blue line here is all items, so that's everything. You can see just how sharply that has been increasing during the past year and a half plus at this point. It tipped down a little bit the past couple of months. Maybe we've seen peak inflation, maybe we haven't. We still are a little bit uncertain about what that peak is going to look like. A lot of it has had to do with energy prices and food prices, which are often very volatile. And that is why we have this orange line here, which is what we call core CPI, and it's all items except for energy and food, because those are the more volatile price points. But that core CPI, you'll notice, has increased very, very sharply as well. And in fact, more recently, we had seen a few months of decline, and then it turned around and ticked back up again, which is really troubling because it means that inflation has become widespread. It's not just in a couple of these lines, and it's not if you look at supply chains, a lot of this early inflation was because of supply chains being snarled. That has basically worked its way through at this point. And so you have other things at play here. Certainly in terms of the food and energy, the Russian invasion of Ukraine was a big factor, and that continues to contribute a lot of instability and a lot of volatility in these prices. So what does this mean for interest rates? The Fed, of course, is trying desperately to bring inflation down. They just met this week and they increased their rate again yesterday. In fact, they went to 3.75 to 4% for their target range. So that was another 75 basis point increase. That's the fourth one in a row now. They changed their wording a little bit in terms of how they're describing what they did and what they're looking for going forward. They did include this language that talks about they're going to look at sort of the lagged effects, because it does take a while for these interest rate increases to play through the economy. So maybe hedging a little bit that they might slow those rate increases in the future, but certainly not giving any indication that they're going to stop increasing their interest rates anytime soon. If we look at the September projections, that was the most recent projections that they did, those projections had a federal funds rate for 2022 of 3.9 to 4.6%. And for 2023, 3.9 to 4.9%. So at the time, that implied rate increases of 50 to 75 basis points at the next 2 to 3 meetings. They've done one 75 basis point increase now. They're still a little bit shy of that 2022 forecast. So they will meet again in December. They very likely will increase again. There's an expectation that that's probably going to be more a 50 basis point increase than a 75, but it will depend on the economic data that comes in between now and then. And again, increases expected into early next year, but it will depend on what happens with inflation and what happens with other economic indicators that they look at. The forecast, again, from the state's Consensus Economic Forecasting Commission, they really upped their forecast for inflation at this past meeting. So 2022, that's this calendar year, their expectation here is 8.3% inflation for the year. Their previous forecast, they met at the end of January and had a February 1st forecast. So a lot less was known about what was going to happen back at the end of January. They had a 5% inflation forecast then. And so that was a really big increase, but they've also increased their forecast for all of these other years as well. And so they're thinking that it's going to take a while for inflation to come back down to normal rates. In fact, they're still at 3% all the way out in 2027, which is the last year of this forecast. Now, they meet a couple times a year, they update their forecast. So depending on what happens, they may bring that back down again if it seems like the Fed is being more effective in bringing inflation down. But all of this inflation has had a real toll on consumer sentiment and business optimism. So in both cases, inflation has been contributing to this downward trend. We did see consumer sentiment tick back up a little bit ahead of the August survey. You remember, we had gas prices, energy prices peaking in mid-June. And then so we saw those prices coming down a little bit. People were feeling a little better. Maybe things are easing a little bit. And so the October numbers, I think they're going to be back down again a little bit. We'll see what happens. So much of what people are seeing in their sort of immediate pocketbooks, if they're at the gas station pumping gas, that has a very immediate effect on their psyche and these consumer sentiment numbers. And this often can be a little bit of a leading indicator, because if people are feeling uncertain about what's happening in the economy and unsure about what may be coming down the pike, they're less likely to go out and spend things and make big changes. And that often then has a bit of a self-fulfilling prophecy, where we then see the economy contract a little bit. So I just mentioned the peak in mid-June of these are oil prices, Brent spot prices, had been coming down. It started to tick back up again more recently. So we didn't make it down quite as far as I would have hoped before seeing those come back up. My hope is that this more recent increase is going to be short-lived and we'll see them continue on a downward trend. But these are very volatile and it does not take much to set these off one direction or the other. Maine is really reliant on fossil fuels. So those oil prices have a big impact on our economy. So one way they have a big impact is because we are really reliant on heating fuel for our homes. So the US is on the left there. That dark blue sliver down at the bottom is the percent of housing units that heat using fuel oil or kerosene. I think it's like 4%. It's really small. Maine is just next to it. You'll notice 60% heating oil, fuel oil, kerosene, etc. We're first in the nation. And in fact, New Hampshire and Vermont are second and third. So we're first and we're first by a lot. Now, this has come down. Actually, not that long ago, we were up closer to 80%. So we have seen some improvement as we've seen a diversity of other heating sources become available. But we really are still very reliant on heating oil, which of course in turn is reliant on crude oil prices. So if those spike, all of us who are in that dark blue section there see a big hit to our wallets. And in fact, heating oil prices started this heating season. We're in yellow all the way over on the left here. We're only a few weeks into the heating season. It starts in October and runs through March, at least according to the Energy Information Administration. According to my house, it starts sometime in September and usually runs through April. But if you look at their numbers, they track prices October through March. We started the season high and it's increased since then. I couldn't believe it when I looked at the second week. So we started, we were, I think, a little bit shy of $4.50 per gallon when we started. And when I looked at the next week, I couldn't believe the increase. That's a really big jump. And it jumped again the week after that. I think the most recent week maybe has eased a little bit. So it's not, or the growth has eased a little bit. So it's higher, but not higher by as much as it had been the past couple of weeks. I would really like to see this come back down again, because this is really challenging for folks who are trying to heat their homes and their businesses. If you are spending this much money on heating oil, that is a lot of money that you are not spending on other things. And that it's problematic, particularly for low-income households, and it's problematic for Maine's economy as a whole. If we look at gasoline, similar story. We had been seeing a decline. It's ticked up a little bit. This is a big rural state. We don't have a lot of public transportation. People drive a lot. So we're spending more money on heating oil. We're spending more money on gasoline. That does not leave a lot of leeway in budgets for anything else. And then on top of that, sort of the cherry on top, electricity prices have gone up a lot as well. One of the big factors here, again, it's natural gas, which you think, wait, natural gas? But a significant portion of Maine's electricity comes from natural gas sources. So when natural gas prices increase, and a lot of this spike was related to the natural gas price spikes when Russia invaded Ukraine, we have a limited pipeline availability to New England. And so we've seen electricity prices increase as well. So energy prices all around have been much, much higher. So a little bit of a look ahead. What are some of the things we're thinking about here? Oh, I said earlier I was going to show you the numbers. This is the state's Consensus Economic Forecasting Commission report highlights. I am not going to read all these numbers off to you. If you are interested, you can go to our website, and I've got that link at the end, but we publish the whole report so you can read the whole thing and you can see these numbers in detail. But I did want to call out, so they improved their employment forecast for 2022 because we had seen that better year-to-date data, and then that flatlining in the out years because of our employment, or because of our demographic situation. Total personal income. Remember I said you weren't going to see any negative numbers. There are no negative numbers there. But when you look down at the very bottom and you look at their forecast for CPI, that is so high that it's eroding that little bit of gain in total personal income. And that wage and salary income, which seems on the face of it to be a very large increase, 11% increase in 2022. That's much, much smaller after you've accounted for that 8.3% inflation forecast. A few key assumptions. So the CEFC, ahead of their actual forecasting process, think about all of the things that are going on in the world and the state that could have an effect on their forecast one way or another. And so they outline all of these assumptions. These are not all of them. These are just a few that are, I think, most important and most interesting to talk about. Economic conditions are very uncertain. There is the potential for a slowdown in 2023. They are not forecasting a recession, but they did acknowledge that there is the potential for a slowdown next year. High inflation, high interest rates, low consumer sentiment, housing affordability and availability, correction in the stock market, all of those things combined, and you have a really challenging macroeconomic environment. There is a risk that inflation is going to continue to be higher into next year. And we've got those higher energy prices being particularly problematic for Maine households and Maine businesses. Again, I talked about heating oil prices in particular. They talk about that in their assumptions. If there's a colder than usual winter, that's another factor that could cause those costs to increase for households and businesses, because it's not just what the price of heating oil is, it's how much of it you're using that contributes to your total cost. Again, they expect that it's going to take several years for that higher inflation to work its way out into more normal levels. We have transitioned to this more endemic phase of COVID. We're all sort of just living with the risks now. And as there are future waves, the economy, the healthcare system aren't likely to be affected the same way that earlier waves did. Now, that does not mean that it's not disruptive for individuals who are exposed, catch COVID, particularly if you have kids in school and they catch COVID, all of a sudden they're home and somebody's got to be home with them. And so there are still a lot of disruptions. And that if you look at the employment numbers, it's still visible in the employment numbers nationally. It's still a factor, but it's much more manageable than it was earlier on from sort of the big economy picture. And there is an opportunity for Maine to continue to see that higher migration into the state. During the pandemic, a lot of people did some soul searching and decided they really would like to live somewhere where there's a little more elbow room, there's some nice outdoor recreation opportunities. And if they have the ability to find a home and purchase or rent the home and have childcare and have an internet connection, Maine seems like an awfully nice place to be for a lot of people. So the expectation is that if we can get over some of those limiting factors, housing, childcare, access to high-speed internet, there are likely to continue to be people who would like to move here and live here going forward. So how much are we at risk in this really uncertain economic environment? And what do we have that might help cushion the blow? So definitely those higher energy prices are very troubling as we're headed into this fall heating season. Seeing prices increasing this early is really concerning in terms of what that might look like if they stay at that high level for the rest of the heating season. On the good news side of things, we're still seeing money from the Maine Jobs and Recovery Plan. That was the federal money that came to the state, and the state put together a plan to divvy up this $1 billion. That is still flowing out. And so that means that there are dollars that are going to continue to flow into the economy that can help support some of the activity going forward over next year. That in particular was targeted towards the investments that were identified in the state's 10-year economic development strategy. So that's really important. The state put together this 10-year economic development plan late 2019, basically just before the pandemic hit. Perfect timing, right? Hey, here's what we're going to do over the next 10 years. And while we did certainly expect that things were going to change, we didn't expect that they would be thrown off kilter by a pandemic first thing. But it actually worked out really well, because what we had when the feds handed us a pile of money and said, here is money to help you get through the pandemic and help you rebuild afterwards, Maine, unlike a lot of states, had a plan in hand that said, here are the best places that you can spend money to be able to put the state in a position for long-term growth. And those included a lot of things that we realized during the pandemic were really important, like broadband, like housing, childcare. So certainly, and workforce development being another really important piece of that. So I think the fact that we had this plan in place with targeted development and then had funding for it is really important in terms of Maine's long-term economic picture. Are we going to continue to see that higher migration? I talked a little bit about this already. You know, we have these key determinants around telework, and that includes both, do we have the broadband availability, and are businesses allowing people to work fully remotely? If you're in a hybrid situation where you need to report to the office once or twice a week, you need to be within commutable distance of the office. You can't be living on the other side of the country, for example. And then housing and childcare, affordability and availability being the other sort of key determinants in terms of will we see migration continue. The other thing I want to talk about in terms of the state budget and the state programs and services, the Budget Stabilization Fund, also sometimes called the Rainy Day Fund, we've got almost $900 million in the Budget Stabilization Fund. There is a statutory cap of 18% of previous year general fund revenues. We're at 16.6% or something like that. So we're really close to that statutory cap. That gives us a really good cushion if there is a slowdown and revenues start to decline. This provides the legislature and the governor with a cushion to be able to continue to provide those programs and services that become even more important during a slowdown without having to make sudden cuts. So I wanted to just outline workforce considerations, sort of some of the things that have been going on, because workforce has been through this big turmoil recently during the pandemic. Migration, will the trends continue? I think I talked about all of this already on the previous slide, so I'm not going to belabor the point, but those are the sort of the three key things that we're thinking about under the migration piece. Retirements, I talked about this way back at the beginning. Are we going to see some of those retirees rejoin the workforce? Wages, we saw wages increase really steeply, and we've seen inflation really increase. How are we going to see wage expectations and inflation balance out? You know, it's a very tight labor market still, and one of the ways you try to attract more workers is increase wages. You can only do that up to a certain point. And so businesses, I think, are starting to think about other more creative ways that they might be able to entice workers. The Great Reshuffle. So there was the Great Resignation was sort of the original term for this. Well, people didn't just quit. They quit and they went and did other jobs. So it really was much more of this reshuffle. And people, I think, were really looking for better work. And in some cases, that was better wages or better hours, but it might have also been just a better work-life balance or a better alignment with personal values. I think a lot of people just decided they needed something different from what they were getting out of work. Now, does that continue? Do we see this as sort of a long trend, or do we see people sort of return back to, nah, I'll work however much, I just want to get the most money and the highest benefits? I don't know. It feels very much like we hit this sort of sea change where people are realizing that there are more important things beyond just the salary and the benefits. Self-employment, and I think this is part of it, is that we did see an increase in people who were working for themselves or doing more gig work, not having just sort of a regular, whatever, 9 to 5, however many hours, a daily job. Do we continue to see that self-employment as a big chunk of overall employment? It's not that those people aren't working, it's that they're not working for somebody else, which means that if you're that somebody else trying to hire people, that higher self-employment rate makes it challenging to find the workers that you need. And that might be where automation plays a role. So if you can't find workers, particularly if you can't find workers at some of those lower wage jobs, replacing them with technology might be an option. And I think we were already starting to see that happen before the pandemic. I think the pandemic has probably accelerated it. And I think it is probably continuing to be a role in the future expectations of businesses who are thinking, well, okay, if I can't find 3 people, I can only find 1. Maybe I can find 1 and then fill in the rest with some kind of technology improvements. All right, things to keep in mind. I think this is my last slide. Housing costs have increased a lot. It's made affordability a real challenge. We've seen those interest rate hikes start to cool demand, start to cool some of those price increases. It does not make housing any more affordable. Mortgages have become very, very expensive. And so this really limits the housing availability going forward. We've seen wages increase, but we've seen inflation increase a whole heck of a lot too. And so those gains in wages just aren't as strong as it looks on the face of it. I just talked about that pandemic-related workforce trends, and that includes pretty much everything I talked about on the previous slide. We're not officially in a recession, but we are still in this period of a lot of uncertainty. And as I said, the CEFC recognized that there's an increased possibility of a slowdown next year. But we have that pool of money sitting there sort of as a cushion in case things go really sour. And we still have this spending from the Maine Jobs and Recovery Plan flowing out to those targeted areas. So there is still some stuff out there that's going to help Maine weather a potential slowdown if it does come. Phew, that was it. So if you want to reach out to me later, you have questions, you're looking for something, my email is here. Feel free to drop me a line. I also put our website here. As I mentioned, the Consensus Economic Forecasting Commission report is there. We also have a lot of data on our website. We publish a monthly economic indicators report. We try to put my slide decks up there as well. So there's lots of good resources there. Feel free to check it out. And hopefully now I've left time for questions, and I'm happy to take any questions. Yes.
Well, we've got a lot of immigrants migrating to Maine who often can't work. They're asylum seekers or they haven't got green cards. Is there any way that Maine, apart from the nation, can, as a state, put those people to work?
I really wish there were. So I don't know if everybody could hear that, but basically, you know, for asylum seekers, they are not allowed to work. They, in many cases, very much would like to be working, and certainly we could use the employment boost that they could provide. Unfortunately, that is definitely a problem that needs a national solution, and that's hard to come by. It's been a struggle for quite some time now. Yeah.
I'm curious about the relationship between kind of information and people's rational decisions when the economy is changing like this. And so we see quite a lot of changes in consumer sentiment right now, driving quite a lot of volatility that I think maybe is unusual in the economy because we can collectively respond so quickly. So I'm curious if we're responding rationally when given information like this, or if the continuous kind of media cycle and the consumer sentiment changing so rapidly is influencing these dips in and out of recession and kind of more stable economic trends?
That's a really good question. You know, I think that there are many economists who like to believe in, like, people are rational actors and they, you know, make rational decisions. I don't necessarily think that's the case. Maybe that makes me a bad economist. I don't know. But I think people are very much in this situation. They are very much being bombarded by rapidly changing news and stories and numbers and not necessarily knowing what any of them really mean. And so I think in many cases, people are relying on what they can see in front of them. And so, you know, when you go to the grocery store and you notice that that bill is more expensive, and you go to fill your oil tank and that's more expensive, and you go to fill the gas tank in your car and that's more expensive, and you'd like to refinance your house or move, but you can't because your mortgage would be 3 times what it is now. All of those things make people feel very insecure and uncomfortable. And if you are feeling insecure and uncomfortable, you are way less likely to be making big changes or making big purchases. And so I think that's where that self-fulfilling prophecy starts to kick in, and where we see consumer sentiment declining so much. It is interesting looking at those consumer sentiment numbers. They turn very quickly depending on some very sort of basic, like, gas prices went down and all of a sudden consumer sentiment popped right back up again. And it, you know, so it doesn't take much, but I think it takes something that people can actually see to be able to feel differently. I don't know that that's a complete answer to your question, but I don't know that I have a complete answer to your question. I think that's sort of the best that I can do for that one. Yes.
I'm curious of whether or not we have any good information about gender wage gaps here in the state of Maine.
Yes. So question about gender wage gaps. I didn't have it in this presentation because I thought I had enough slides already, but I do have some presentations where I do have a slide on that. There is a gender wage gap. It does exist. It is persistent across different industries, different occupations, different age groups. It's not terribly different between Maine and the US. I mean, it's a national problem as well. And it's been a problem for a very, very, very long time. So it exists here, it exists across all of those different categories, and it is persistent.
Can I ask a follow-up?
Yeah.
Have you been following the salary transparency wage laws in like California just recently in New York, and whether that has an impact and whether it could have an impact here in Maine?
Yeah, so I think it's too early to tell. You know, a lot of those are very, very new, and it takes a while for those kinds of things to flow through, and then for the research to be done to figure out what the effects were from those. So I expect there's clearly a huge amount of attention being paid to those, and particularly because they're sort of state level, you get some natural experiments that happen where you can sort of compare what's happening in one state versus another, that have different policies in place. So I think that there will be a huge body of research that comes out after they've been around long enough to be able to see some of the results from those. And I look forward to seeing what comes out of those, because I think it'll be really interesting to hear. Yes.
One of your slides said that building supplies was the largest growth, and yet housing stock doesn't seem to change. So I wonder, does the state try and track housing stock?
So yeah, so the first thing I'll say, so the taxable retail sales for building supply stores, it includes all sorts of stuff. And so it's not necessarily just lumber and construction equipment to build a house. And, you know, if you think about some of the building supply stores, they also sell things like plants and garden equipment, and, you know, it's consumers who go out and buy those things. And, you know, they're often maybe doing renovations to an existing property, not building a whole new one. In terms of housing stock, that is tracked, and it is very low. There has not, nationally, not just in Maine, there just has not been a lot of building growth happening in recent years. Actually, the demographic situation is one of the reasons for that, because when you are thinking ahead to building houses down the line, if you're a big construction company and you're going to build houses, you look and you say, okay, well, how many new households are we going to have? Well, one of the primary drivers for new households is kids who are growing up and leaving their parents' house and starting their own household. And if you look at the demographics with all of the baby boomers aging up, and particularly in a place like Maine, where that's the biggest chunk, there just wasn't a lot of demand. And in Maine, we didn't have a lot of new households coming from that side of the picture. And we also had pretty slow migration. So we didn't have a lot of demand on that side either. And that sort of has set us at a disadvantage in terms of available stock. I think the other piece of housing stock that's important to keep in mind is not just the sort of total number, but the age and quality of it. In Maine, we have a lot of very old housing stock and not necessarily great condition either. And so there's a question about, if you're trying to turn over housing stock, is there housing stock that's desirable to people who are looking to buy a home? So all of that constrains the available supply considerably. Saw another hand back.
I'm actually going to interrupt because unfortunately we've run out of time.
Oh, no. Oh, well,
So I want to thank everyone
you.
for coming, both in person and via Zoom. And I want to thank the Camden Conference people, especially for coming in, and to Amanda for such a wonderful talk. And I'm so sorry that we ran out of time.
Thank you.